Welcome to the Millennial Money Canada podcast, a podcast to elevate your financial planning literacy so that you can live well, build wealth, give generously, and leave a legacy that you're proud of. I'm Guillaume, Girard, financial planner, and I'm joined by my co-host, Sam Lichtman, founder and financial planner at Millennial Advisors. The topic of today is 5 money habits of wealthy millennials, or 3 ways that millennials get to their first million, and then 5 habits that they do to maintain their wealth once they get there. Also, if you're new to this podcast and you've enjoyed this podcast, you can rate it on Spotify or Apple Podcasts by just clicking on the stars at the top, or leave a comment if you're on YouTube. You can also make sure you follow us as well for the latest drops. We drop an episode every week. But before we dive into the topic of today, Sam, do you want to share a little bit of what you're reading? And I'm going to share as well what I've been reading lately.
Yeah, so I'm reading 2 books right now, kind of interchangeably. Well, I guess 3 based on your recommendation, but I'll let you talk about that one. I'm reading The One-Page Marketing Plan by Alan Dibb, and it's a book on just how to optimize your marketing efforts and make sure that you're on track to accomplishing your goals. I'm trying to dive a little bit more into marketing this year and make sure that that our brand is being, exposed to more and more of our target demographic, which is Canadian millennials. And so this one's going to be helpful. I'm like a quarter of the way through it. It's a good book. I think it's applicable to it is applicable to any business. And so, yeah, that one. And then I'm reading more like a personal, like self-help, I guess you could call it, book. It's called The Constellation of Philosophy. This one's super interesting. So back in I think it's 1st century AD, a guy named Boethius, who is like a Roman elite, gets stripped of his status, his wealth, and all of these things, and gets thrown into a prison, and he basically journals his time in prison and the way he rationalizes life and wealth and all of these things. It's a fascinating read. So essentially what ends up happening is he has like this vision of this lady named Philosophy who comes down and kind of counsels him through this process and asks him a number of questions and those types of things. It's quite fascinating, and they go through all of like the why do you want status? Why did you desire wealth? Why now that those things are taken away from you, are you sad? Why now that like you're imprisoned, are you sad? And it just goes through like the way he frames his mind in that situation. And it's fascinating. Kind of, it's helping me reshape the way I think about like attaining wealth and status and all of those things, and like how easily something can come to you and then be stripped away. And so anyways, it's a little bit of a grounding book. I'd highly recommend it to anyone. It's quite fascinating to dive deep into someone who's kind of experienced the heights of wealth in such an early age, right? Like all the things that he writes about, we can relate to right now, which is also quite fascinating. But yeah, being able to read through someone who's been at the top and then who's been at the literal bottom and just kind of seen the mindset that they adopt to help themselves survive, it's amazing book.
What's the title again? One more time.
The Constellation of Philosophy.
The Constellation of Philosophy. Okay, I'm going to add this. Never heard of it, but I love those books, man.
Yeah, it's fun. It's a great read, and it's an easy read too. It's fun. Yeah. And also like challenging. It'll challenge your beliefs and notions around wealth and status and happiness and all of those things. And, just to go back to, because I've always been a person who doesn't desire happiness as like my end state. Like I don't think that happiness is like my ultimate achievement. It talks about that a lot. And it's like, true happiness, what is that? Trying to define it. Can it be attained by riches? Can it be attained by the illusion of having freedom in this world and all of those things? And ultimately they just decide or find out that like, no, that actually can't be it. And yeah, like it maybe a little bit of confirmation bias, but it talks a little bit more about like how living a fulfilling and meaningful life is the way to go, and making an impact is what brings fulfillment in life. And that means there's struggles and sacrifices, and it's not all about joy and happiness. So, just in my own personal journey, I can relate a lot to that. And so it's a really, really affirming book, and yeah, I really enjoy it.
Yeah. In aligning to this topic, one of the book that there's three that I want to touch on very briefly, but two that I read. When one is called Halftime by Bob Bufford, moving from success to significance. So very much in line with what you just covered, where the first part of our lives, usually it's focused on growing your career, education, making money, like establishing a foundation, even finding, what you're good at, what you're not good at, what's your craft, what do you want to kind of spend the rest of your career, or at least you think that's going to be the rest of your career, but you're not necessarily thinking, or at least, even myself, like to then take a bigger approach or like a more of a macro approach to your life in a way, because you're more in the weeds, you're almost trying to survive really, right? Maybe you start a family, met your significant other and then start building a family and whatnot. So, but that book covers that part. And then he covers what happens at the halftime. And the halftime is not an age. It can be any time in your life, right? But there's going to be a halftime point where, and some people may never get there, but the sooner you get there, the more you can actually take a pause in a way and then focus on, okay, what's going to be the significance, which is going to be the second part of your life. Mm-hmm. And I thought it was a fascinating book too. Just like you mentioned, like you just realize like what brings you fulfillment, which is like way beyond just your own happiness. Like what legacy do you want to leave? And yeah, so anyway, just really good to reorder everything that you thought was important or a priority. Now suddenly your list has been reordered. Yeah, so it was really cool. So yeah, Halftime, highly recommend it.
What are you reading right now?
Yeah, that's the latest I've read. The other one too that I've actually listened to, a podcast was just published in February. It's called The 5 Types of Wealth by Sahil Bloom. And Sahil Bloom was on Nick Bare's podcast, which Nick Bare is a founder of a spreading company in the United States called BPN. And it was an amazing podcast. So anyway, I saved the book. I started reading just the few sample, but that's going to be my next one, The 5 Types of Wealth. And in that similar mindset, the guy's ex-private equity guy. So he worked 80 to 100 hours a week, first part of his career, graduated from Stanford, was on the baseball team over there, like just like a workhorse all his career, got out of school, thought he had to make a lot of money, good job anyway, went to a point where everything else was falling apart. His personal life was falling apart. They couldn't conceive. They couldn't get pregnant. His wife couldn't get pregnant for various reasons, and just everything else around him. Even though on the surface he was looking extremely successful, there was so many things in his life that was not going well. And then he hit that point, and that led him on this journey and write the book. And so I'm excited to read this. But that's gonna be my next one, The 5 Types of Wealth. So.
That's awesome. And I feel like that kind of leads a little bit into what we're talking about today, which is the millennial money habits and like the 5 things that millennials do to, like, once they've achieved that $1 million net worth, how they get there. But then once they get there, what are the typical next steps? I'm excited to dive into this topic because, over the past year, a lot more of the clients that I'm working directly with have achieved that $1 million status in investments, net worth, real estate, whatever, what have you. And we're now looking at, okay, well, what are the next steps? And after analyzing like the commonly asked questions and what they're desiring to achieve, I put out a YouTube video just a couple of days ago on the 5 millennial money decisions or money habits that millionaires make. And so I'm excited to dive a little bit deeper into that today and walk through our experiences in managing money for wealthy individuals who've gotten there, mostly first generation, created their own wealth. And we're not talking about people who just were handed a large sum of money from inheritance. We're talking about people who, started from essentially nothing and now have gotten to the point where they're managing this amount of money. And so I'm excited to dive into that with you.
Yeah. Before, can you start with the first question, which is, what are the 3 ways or most common ways that millennials get to their first millions?
The 3 most common ways millennials get to their first $1 million. The first one is through starting a business early. And so whether it's someone you meet in university, it's a classmate that you studied with, what have you, typically I find that, and it may not be their first business, but many of these individuals were so laser focused on what they wanted to achieve right out of university that they teamed up with a partner. And this is key because, it was actually fascinating to me as I started to look into this and do this research that like, and this is anecdotally speaking, of course, but the individuals that were the most successful were ones who partnered with someone with contrasting skill sets. Sometimes it was friends, sometimes it was opportunistic, two people both looking to start a business and they found each other. But looking at like an engineer and a business major, right? And those two individuals came together with a common vision and created a company. And so obviously it's really tough out there for businesses, especially in Canada. We don't get the same support that we get elsewhere for businesses. So you really have to be top quality. And it's really hard for one person to have all of those qualities that can make a business successful, from the technical skills to the competency and all those things. So as I think back, it does make sense that like, okay, two people partner, contrasting skill sets, clear vision. And one of the things that clear vision has done is it's also prevented them from making common time mistakes, because what we have in our 20s is a whole bunch of time to do really dumb things. And we can recover from that and, reorganize our life in our 30s most of the time. But typically the people that I find that have achieved that millionaire status, when they started in their 20s, they didn't end up sacrificing a lot of their time to the things that, a normal 20-year-old would do, going out, drinking, partying, even lots of traveling. Like they sacrificed that in their 20s, and now in their 30s, they've got a lot of time and freedom because of the wealth they've attained. And so that's the first most common way I would say I've seen millennials get to that $1 million mark. Yeah. Like, I don't know if we can talk about the other two in a second here, but even from your experience looking at like the people you've come across in life, would you agree that that's probably like the most common way to wealth you've seen?
It's definitely, I think even from my own experiences, I think there's a big difference between someone who's employed versus someone who is an entrepreneur. And I'm living it like in the last 2 years. If I look at how I'm living versus when I was, let's say, an employee, when you have a guaranteed paycheck, it can depend where the business is at for sure. But when I was an employee in my 20s, I wasn't focused on, I was focused on growing, but I was focused on my education and I was focused on saving and whatnot. So I guess I did have that little like entrepreneur mindset as far as being maybe scarcer amount money or being good with money and all that stuff. But outside of that, I wasn't thinking too much. I wasn't consumed by a business. So I can see in your point where if you start a business very young, that's going to consume the majority of your time. I mean, if you really want to be successful, there's no time left with partying and all that stuff and being distracted.
Yeah.
But when I was an employee, I would, especially the role I was in where I was like entertaining clients, I think I was very distracted, and it's the CFAs and all those courses that kept me grounded in between. But I think that there's a huge difference between someone who's salaried or, is an employee versus who's running a business. Big difference, which is also what sets up the stage for their next decade later. And that's where they end up usually at different places where the entrepreneur is now capitalizing on the efforts that they've put in for the past decade and the trade-off that they made by prioritizing building the business.
Yeah. And I think it's not saying that like we haven't seen people who've been diligent savers and gotten into high paying jobs and those types of things. I'm actually going to cover that in a second. Obviously, like employees, if you get into a good job and you are disciplined and those types of things, you can still grow significant wealth by the time you're in your 30s. But it's a little bit different for business owners because the ceiling doesn't really exist. You're not capped by a paycheck. And so if you have that motivation to get wealthy, you know that every single one of your activities has the power to create wealth. And so it's a little bit of an addictive, repeated loop where you do something, it works, you get more money, and then you're like, oh my gosh, that works so well. I'm going to do it again and again and again. And all of a sudden you find the thing that works. Now, built in there is the 100 things that didn't work to grow your business. And I'm definitely an example. Like I started in business at 22 at a big firm. It was kind of like an entrepreneurial advisor role. And yeah, so many things didn't work, right? Like we tried different things to try to grow the business. And ultimately what it came down to was social media, being present in front of a large group of people, sharing a very clear, simple, and consistent message in front of people over and over and over again ended up being the thing that worked. And now we're doing it on different platforms. But there is built in there is hundreds of, I guess you could say, like, they always say like have a bunch of lines, like fishing lines in the sea, right? To to try to get the most fish. I guess built in there is hundreds of snapped fishing rods that just did not work, right? And so, but it is this addictive, repeated loop that business owners can have. And really the ceiling doesn't exist if you find the thing that works. And you also obviously have to live at that point in time too and be able to sustain yourself. So I think there's a balance there to be drawn. Like if you're 2 years in your business and you haven't seen a paycheck yet, okay, maybe it's time to rethink yourself, your goals or what you're trying to do here. But like if you can sustain yourself, you don't need a lot to get by, and then you just build slowly but surely every single year. And I think we've seen that example dozens of times with people that are coming to work with us, whether they've started their own company, joined a company and bought equity in it, or partnered with someone. It's just such a amazing wealth creation.
Yeah. It's funny because I hear you about like starting businesses young, and last week in our podcast we had John Bromley as a guest, and he talked about being an accidental entrepreneur. And I don't have a single ounce of being an entrepreneur in my family's blood. Like I was thinking about that the other day, and no one has ever started anything. Like my dad worked, DB pension, worked for the city, mom worked for a company. The only time I got exposed to business was when my mom remarried. And he built like he's selling group insurance plan. He's a group insurance broker. So she remarried and he built like his own business. He was a solopreneur all his life. And then my sister bought him out. So that was my second exposure to, okay, my sister's now a businesswoman. She's managing, my mom is like an employee in the business. And then Kayla, my fiance, she started her own business, and I've seen over 5 years, like the ins and outs. And I was still an employee back then. I was like, you'd have to be nuts to choose that route in life. Like, you have to be. I could not. I was like, why would you do this to yourself? And so she was the second, I guess, after my sister to see, her being like what a business owner looks like. And you're basically the third. And we started together, and then seeing you like again everything you do around like running the business, which in the in the back end, I'm ultimately like a business owner myself as well. So anyway, this is. But yeah, I had to learn. You can learn it. I think the takeaway for the listeners is it's never too late. You can learn it. It might be really hard at first, but it's possible that if you're consistent and persistent, and the why is bigger than every roadblocks that you're facing, that you're gonna just keep going. And
that's such an important distinction. Like your reason why has to be bigger than the challenges you're gonna face. Read a book recently. What was it called? I'm just gonna look it up here. I think it's like The Obstacle is the Goal.
The Obstacle is the Way.
The Obstacle is the Way. Yeah.
That's a good book.
And it talks about like facing obstacles, and the bigger the obstacles you're facing, the better, because essentially like, you're scaling, you're on the right path if you keep facing new obstacles. And I was thinking about that. I was having a conversation with someone a while back, and he scaled his business to like 500,000 in revenue in the first like 2 years. And then all of a sudden he got hit with his first lawsuit. Right. And he's like, I thought like these 80-hour weeks were hard. That's nothing compared to like, oh gosh, I've got a lawsuit on my hands. And it was nothing in relation to him being unethical or anything like that. But like, it just happens that like you're in business long enough, you're going to get hit with these different types of challenges, right? Like for me, like this last year, hiring was a hard thing to try to go through. That was a huge learning curve. So like for me, I feel like I've got a good foothold in my side of the business, but then bringing people on to complement that and to try to scale that way, man, that slapped me in the face so hard to realize that like, okay, this is difficult. This is my next challenge I've got to overcome. This is something that is going to take time. And the funny thing about this business and scaling and all of these things that I'm learning, you just have to survive it. Like, and it doesn't matter how you survive it. You just have to survive it, because in 10 or 15 years after starting, that's the point when you almost regardless of your skill, and we see it all the time in our business and other businesses, it actually doesn't necessarily matter how skilled you are at what you do. It's about longevity and persistence. Sometimes we have issues with that, because in our business, you do need some skill to be actually able to help clients the right way. But we see that all the time, where it's like you could be the most skilled person in the room, but if you don't have accountability, or if you don't have communication skills, or if you don't have one of these critical components, it's going to be really difficult. But if you're around long enough, you'll learn those things. And that's really at the end of the day, what it comes down to is like, you have to be there in 10 or 15 years. And if you're not, then obviously you fail. And so that to me, that's one of those profound things. Just keep going. Just don't stop when things get tough. So anyways, that's the first thing I've learned. And honestly, think about like learning those skills in your 20s, how valuable that is for the rest of your life. Like both me and my best friend, we started businesses at the same time, and both of us have gone through different challenges. He scaled his business to well over $1 million in revenue, different type of business, very high overhead, all of those things. But both of us are now like, man, if we start over tomorrow, like I feel pretty confident that we could do it because of the lessons we've learned over the past 10.
That's worth so much, man. Yeah, Caleb speaks the same as well.
Yeah.
Like as far as you can't buy this, and that's what you have to go through it. You have to experience it. You can learn from others 100%. Of
course,
but you have to once you go through it, yeah, it stays with you forever.
Yeah.
Right. So
probably the second way.
Yeah. What's the second most common way we see millennials grow their wealth to over 1 million?
Yeah. So this one is I'm speaking about a little bit older millennials in this case. So this would be like, maybe people in their late 30s, early 40s. The oldest millennial, I think, is 43 now in 2025. And so this has been a controversial like topic conversation, especially in Canada, but it's been through real estate. And the reason I say it's controversial is there's a lot of factors outside of your control that go into real estate. And just because someone did it successfully 10 years ago does not mean the next 10 years are going to be the same. In fact, personally, and this is not advice, but like personally, I'm not bullish on real estate. Personally, I wouldn't own real estate outside of a primary residence. I don't. In fact, I rent right now. We sold our place back in 2022 and been happy renting. But at the end of the day, what ended up happening was, 2010, 2011, 2012, we had pretty low home prices at that point in time, and we had pretty low interest rates as well. And so people graduated university at that time, got into the job market, got a pretty good, like high paying job, making six figures plus. And those individuals ended up just essentially leveraging their way 5-10% into a primary residence that they bought right away. And now those places they bought for $400,000 or $500,000 are worth like 1.3, 1.4 million. Their mortgages are either at like $200,000 or less, or sometimes they've been even paid off, or sometimes they've basically refinanced that into rental property. So that's the second most common way I've seen. Typically, individuals living in like the GTA or the GVA are, have seen the most growth on their real estate in that aspect. So I don't necessarily recommend a leverage strategy going forward. However, it has worked for people in the past 10, 12 years, but that's the second most common way I've seen. And honestly, we've seen so many people that kind of, have intro meetings with us, and we run their net worth and all this stuff. And sometimes we see them like, okay, we've got like $75,000 in investments, cash, and those types of things. You've got $1 million net worth, like 900,000+ of that money, or almost $1 million plus of your net worth is tied up into real estate. It's not as easy to access that money. Of course, there's home equity line of credits and those types of things. It's not a very liquid net worth for a lot of those individuals, unless they've like refinanced at the perfect time, invested in the stock market, or paid down their mortgage, and now they're saving like $7,000 a month, those types of things. But that's the second most common way I've seen. I would not bet on that being available to people for the next 10 years.
Yeah. I mean, there's a few comments I want to make on this. So first, I think it depends where you're at in life as well. Like when you look in hindsight, of course, if you graduate from university and you knew you would be in that city, in that field for a certain period of time, then taking a risk, buying a condo, a townhome, or a detached home back then, of course, you've made a lot of money. But like just giving you my my scenario, like I moved 12 times, since 2011. 12 times since 2011. So that was, when you're always on the move, whether it's for work or, co-ops when I was at university and whatnot, right? So there's a lot of moves there. But if you're moving a lot, of course, that was harder to capitalize on. But the other thing that I think was interesting is, I don't know if you heard about that, but there's a lot of research that shows that when you're young, you should actually borrow as much as you can to a certain extent. And the mindset is, and that's not what we're recommending, but the approach is that when you're young, you have a lot of earning potential over your career, which is called your human capital. So from an asset allocation standpoint, you would want to offset all the human capital that you have ahead of you with debt. And then when you offset, so you offset, and as you age, you have less human capital, but also you paying down your mortgage. And then ideally, by the time you get to retirement, this is kind of where you have like your target equity exposure essentially. And then again, you would have to liquidate part of your home or bring liquidity out of your home to turn it into stocks, for example, to, spend and whatnot. But that's another challenge. But the whole point is there are some research out there that are supporting borrowing a lot. So I guess it depends of course.
Research.
Yeah.
Yeah. And the problem I see with that research is like, you look at it on paper and you draw a linear line to age 55.
Yeah, exactly.
Oh my gosh, look at this. And then reality is like,
yeah,
what is the decision-making capacity of a 22-year-old?
yeah,
Right?
exactly.
Like, are they going to like YOLO all that money into memes? So I don't know. Right. Like, but a lot of them would. Right. And so the problem with that is, are you setting yourself up for success? And I've got a lot of strong feelings about leverage, and even in low interest rate markets and strong equity markets, I don't think it's necessarily, a wise decision to make. And it's funny because like in our business, you always have to look at what's the reason behind the leverage. And when we're talking to regulators, you can't put potential human capital as an asset on the balance sheet, right? And so often it's like, well, they can only leverage up to the amount that, they're worth, or the amount that they have in liquid savings. So if they have like 60,000 liquid savings, they could borrow another 60, something like that. And so when we're looking at strategies like that, I mean, what's the actual positive net impact over a long period of time? And what's the potential risk of ruin over a long period of time? And the emotions around managing that at 22, 23, 24 years old, I feel like we're just not emotionally developed enough at that age. Most of us aren't, to make sound decisions with our money. So I have some issues with, because I've heard people preach that, and I know you're not doing that, but I've heard people say, just like borrow as much as you can, use other people's money to get wealthy and all this stuff. And I hate that message, because it can work, and it can work on paper, and everything looks good on paper until you get hit with real life.
Yeah, exactly. It just depends on the scenario, and depends of even like controlling yourself, your emotions, and how that's impacting also your way of life. Like some people, they might disregard this. They say it's just, on paper, everything works out. But for me, I'm very analytical, and even that would like stress me out. Like I love to have, and again, depending on, I'm a renter as well, but I'm excited to own a home at some point, and ideally, and all the clients that we're seeing also that either achieve their millions or they're close to being millionaire. Like if you notice, their debt in relations to the other assets that they have is relatively low. So I think just even from a peace of mind perspective, I just want to have everything that is in line. I wouldn't want to be overstretched regardless of how much human capital I have ahead of me or all that kind of stuff. Because on paper, it looks amazing. But in terms of flexibility and having a margin of safety when something could go wrong, I think this is a lot more important for me than like maximizing, I guess, my wealth on paper, so to speak. So.
Yeah. And there's no guarantee you will, right? Like, because leverage has high risk. You can ruin like your like your whole financial future using leverage. So I don't think it's a risk worth taking. I mean, I know a lot of business owners will borrow money to fund inventory or those types of things. I think that's a bit of a different thing, but I think personally, when you're just banking on yourself making more money in the future, I think you start with saving what you can afford to put away on a monthly basis. Don't overextend yourself.
That's so well. So yeah, what's the third way that you're seeing millennials grow their wealth to over $1 million?
The third way is through stock compensation with their employers. So I've seen this happen in a few different types of ways, right? So RSUs, or restricted share units, with publicly traded companies. That's a big one. So someone works at one of the Magnificent Seven companies, and they're a developer, and they get stock compensation. They've gotten stock compensation for the past 10 years. And we've seen the ridiculous returns that those companies have had over the past 10 years. And so like publicly traded company employees receiving stock compensation through options or RSUs. And so that's been a big one, but also individuals who have worked at previously like private companies who either got bought by private equity or private companies that IPO'd, which an IPO is when a private company goes public and basically offers shares to the public that they can purchase through a stock exchange. And so when that happens, then the public market set a valuation on the price in conjunction with the company that helped them go public. They'll set price expectations and all of those things. But often, these people have bought in at pennies on the dollar into their stocks. And now, even if they bought it in a cost basis, an average of like 50 cents per share, even an IPO at like $2 per share just skyrockets the amount of money that they have there. So we've seen that happen through private companies going public, private equity buyouts, and through public company stock compensation. The key there was that they stayed at one place for a fairly long time, at least a decade. And so when we're looking at like their track record, it wasn't like overnight instantaneous, but it was like 30% return on their stock and a 60% return the next year and a 30% return the year after that. And they're often putting 25% of their salary in a company stock. So very concentrated positions, very risky, but at the same time, typically these individuals were high earners that were saving outside of this as well. And so that's been another thing where that's kind of skyrocketed them into the position, well, now I've got like $1 million in stock. What do I do with it? And that leads us kind of into the next point, which is like, okay, once you're there, what do you do with it? But those are the three most common ways, right? Business owners, real estate, and stock compensation.
Business owners, real estate, stock comp. Okay, perfect. So
do you disagree with any of those, or would you add anything else in?
No, this makes total sense. I mean, the business owners, they're just reaping the rewards from all the risks that they've taken, and that's what I'm realizing right now. And then real estate, of course, Canadians love real estate. And then we've planned for a number of folks, millennials, who are working at the Magnificent Seven companies. We've done financial plans only with them, some with managing money as well. And yeah, they make extremely high salaries. A lot of their comp, again, like you mentioned, is coming through RSUs, and there's a lot of tax planning opportunities there that we can help them reduce that taxable event, essentially, when get dispersed to them. Yeah, no, I agree with that. I agree with that. Now let's move to the 5 common things that millennials do to maintain and grow their wealth. So once they get there, what do we see them, what do we see them doing so that they continue to maintain it, grow it? But what are the 5 things there? So the first one, what's the first one, Sam?
Well, the first one is a lot of them want to turn their minds to risk management at that point in time and look to figure out, well, I've gotten over this hurdle of saving $1 million. Now what do I do? Right? Like, I don't want to go back. And so how do I go and not only increase what I have, but also make sure I don't lose it? And that's typically where you and I have come into the picture to meet with these individuals, because this is the point in time where they start to think about those things. And so we get to then look at their history and say, okay, this is how you got here. And that helps us to plan for their future and say, what are you likely to do in the next 10 years, which helps us determine what to do with the money they have now. And so typically it's looking at things like diversifying their portfolio. It's looking at ways to make sure that their business is structured the right way as they're all of a sudden now getting into more cash on hand, those types of things. It's kind of interesting too. A lot of the business owners in this scenario that come to us, it's not like they have $1 million invested in the stock market or diversified and through different asset classes or holdings. Often it's cash. This cash has been burning a hole in my checking account for 6 months, and I need to figure out what to do with it. I need a plan. And so that's where all of a sudden it's almost, for them, they spend so much time focused on their business that now this is a new challenge for them, which is, okay, now I've got cash. What do I do with it? And what do I do with the cash next month and the month after that? And so that's where diversification comes into play.
I mean, that's probably the number one questions, or I would say topic, that we cover. I would say in every single meeting that I have. I wouldn't say regardless of your wealth, but I would say especially with people who have done well, to make their money work for them in an optimal way. And there's a huge opportunity loss for, sometimes it's for a couple of reasons. One, like you said, they were just so busy with their business that financial planning takes a backseat, which is totally normal. And that's where we can help you, again, continue to grow your wealth reasonably, right? So especially when you get there, one thing I love to kind of remind people is, once you get there, like when you look at 2024, for example, and this is like small sample set, but like when markets are up 20-25%, you've accumulated, let's say, $1 million between your business and your registered accounts and non-registered account. I mean, 100% equity portfolio, like you've made over 200 grand, like pre-tax. That's crazy. Like, think about how much you need to work to save that amount. And you've just made it. This is like passive income, like not distributed to you, but passive growth, passive investment income. So when you put that in perspective, it's, once you get there, it's about growing reasonably, conservatively. But yeah, after that, there's, you usually like your financial goals are going to be all met from that point on, because just of the foundation you've built for yourself and the compounded growth, how it's going to just keep snowballing and growing, year in, year out, right? Not every year will give you 20%, but the whole point is to capture that, which, funny enough, a lot of people don't. That's what we're here for. That's what we help them do. They have the opportunity, but sounds like they don't.
Yeah, and it's not like
Awesome.
it's not
Second
like they
thing,
don't
what's this?
capture it.
Yeah.
Well, it's just to go back on that point. It's not like they're not capturing it because we can give you the best investments in the world and we'll help you capture the best returns. There's all sorts of DIY options out there, but even those investors who are investing in the DIY options that are sound ones still are having trouble capturing the market return. It's just because of the emotions. I know this is a bit of a rabbit trail, but that's again kind of leads us into our next point, which is the second thing that millennials typically will do and should do at this point in time, is seek out professional tax advice and financial advice. And I'm going to caveat this here, because when I say financial advice, often what I see is that people will turn to the person who has been asking for their business for 2 or 3 years. They met them at a networking event or something like that. And well, there's nothing wrong with that. But what I've seen very commonly happen is the first person that they turn to for financial advice goes and sells them a big fat whole life insurance policy. And that is not financial advice. Okay. So I just want to put that out there very clearly. Financial advice aligns with tax advice and tax planning. And it's about structuring your finances the right way, whether you're a real estate investor, whether you're a tech employee, or whether you are a business owner. It's about structure. It's about goals. It's about your future. It's about registered plans. It's about tax planning. All of those things can combine into financial planning, and insurance can have a place. But I've seen it way too many times where there's no due diligence done on the financial advice side. And all of a sudden they find themselves with this amazing product that doesn't actually make any sense for that individual. But the tax side of things, this is definitely an area that people should stop filing with H&R Block and go seek out the advice of a competent CPA. And not just a CPA who files taxes, because those are a dime a dozen, but someone who does tax planning and who works on tax structures. So especially for business owners here, right? The amount of times we've seen business owners who are at a place where they've got high balances in their notional accounts, which means they can pay money to themselves tax preferentially, and just haven't taken advantage of that for 3 or 4 years. There's been cases where people have had like $100,000 sitting in a tax-free capital dividend account because of a sale of an asset or something in their corporation, and they can take out a bunch of money tax-free. They just didn't know, right? Because they didn't have tax plan. On the other side, I've seen where structure is so important is when they're owning a business that they want to sell at some point, and 100% of the shares are owned by the holding company, and that means that you can't sell that business and get the capital gains exemption because the shares need to be personally owned or owned through a trust. And so those are all things that, business owners are way too busy thinking about their business to actually realize that. And then when it comes to like the stock compensation side, RSUs are granted, 50% goes to tax, 50% hits the account and stays invested. And then there's additional capital gains when they want to diversify. So having a plan around how you receive your compensation, having a plan around how to mitigate income taxes on that, and those types of things is also really important. And then lastly, I'm just going to quickly touch on the real estate side. If you're a real estate investor, there are so many different tools available to you. Everything from cash damming strategies, which can lower your taxable income throughout the year and save you thousands of dollars in taxes every year, to you can do debt swaps. Again, this is where an accountant needs to come in and make sure it's done efficiently, where you essentially swap principal residence non-deductible debt for deductible debt, and now create larger deductible debt and essentially allow you to pay cheaper after-tax dollars towards your debt. And so there's things like that you can do, refinancing ability, Smith maneuver. Those are all tax planning tools available for real estate investors that go way, way overlooked in terms of the financial planning, tax planning space, and goes so far beyond just the basic advice of put $1,000 a month into these mutual funds or buy this insurance policy. All of these things kind of go hand in hand. And so often millennials will overlook this part, but often at some point they'll come back to it. And how many times have we heard someone in their 40s say, I wish I'd done this 10 years earlier? I lost count, right? Like, oh, I wish I knew you guys 10 years earlier because we would have gotten this all set up then and would have saved tens of thousands in taxes and all of that stuff. So it's really important that when you kind of hit that level, you really start looking into these things. Competent CPA, competent financial planners.
Yeah. So just to come back to the cash damming that you've covered just very briefly. So what you said there was, just to summarize the whole strategy, is you want to shift basically your personal debt towards the business debt so that you can deduct the interest because you're using those funds for the business. So you're borrowing to fund your business expenses. Is that right? Or can you just clarify what you're doing there so that the listeners understand like what you mean by this at a high level?
So cash damming is something we can go into a little bit more in depth on in another podcast or video. But essentially, like if you're a self-employed business owner or if you own rental property, you can basically swap where you pay your business expenses from or your rental property expenses from. Instead of taking it from the revenue generated by the rental property, you could essentially borrow the money to put it against those expenses. And then the debt becomes deductible and the expenses are deductible. And so you're creating an additional deduction. You're creating more debt, but you're also creating an additional deduction there for the interest paid on that debt. So it's essentially a leveraged strategy. It's a little bit easier to explain for small business owners who don't incorporate, where essentially if you have $50,000 in business expenses, those expenses are deductible against your income, but instead of paying that from your business revenue, you pay that from a line of credit. And then you're using your income to pay down any mortgage debt that you have and using a loan to pay for business expenses. And what ends up happening is you're shifting mortgage debt to deductible business debt. And it's the same type of idea with rental properties. You can do that with rental properties. And as long as the business debt is going to fund business expenses and there's a clear line, like separate sub line of credit going to directly pay for business expenses, those business expenses remain deductible. And then the interest on the debt becomes deductible. Whereas before you were just paying down non-deductible mortgage debt. Now you're paying business expenses from deductible. Then you're shifting debt from your primary residence into this business line of credit. So your debt levels stay the same over time. You're not actually paying down debt, but you're using money to fund business expenses, creating an additional deduction, and that over time can save you thousands and thousands of dollars in taxes.
Yeah. This is the business equivalent of doing this mid-maneuver personally, where when you're paying your mortgage, you're re-advancing into the line of credit. That line of credit now becomes, the interest on it becomes tax deductible, and then you can reinvest the proceeds. But it's the kind of similar cycle of cash flows.
Yeah. Before you take advantage of any of this, make sure that you get professional tax advice.
Yeah. Plus, the thing that with those strategies, I haven't implemented any of them yet, I would say, because I think they're I would say down the road, they're important to look at 100%. But sometimes, at least the people that I've encountered over the past year that I'm working with, there's so many things before that we need to address that have tens of thousands, millions over a lifetime in terms of wealth accumulation, giving you going from 80-20 to 100% equity portfolio and being the coach or the advisor that will walk you through those cycles. I mean, that itself on the latest client that I've done, was adding 2 million over his lifetime, right? That's crazy. Those are the big moves and adjustments you need to make. And then, of course, you want to go down the list and try to cover everything, which is what we do have, through comprehensive financial planning work that we do. But yeah, sometimes you can't be missing the big picture, though.
Yeah, absolutely.
Okay, so what's the third thing that millennials do to keep their world together?
I said it's a tongue twister. Millennials. The third thing that they do is they develop good habits around money. This is everything from market reactions to being sound with their spending habits. And so with this, I'm not suggesting that millennials live like they are broke. Like, these individuals don't live like they're broke. They still go out, they still, drive nicer vehicles, those types of things, which I'm going to get to in a second. but they're very conscious of where their money goes and they're in control of where it goes. And they're used to a lifestyle sustained on their income. And so once they've hit this $1 million in net worth, in investments and cash in their business, what have you, they're not then going out and buying a bunch of Rolexes or a Ferrari or something like that. They're very happy with their lifestyle that they've created for themselves. And that money can now be used to keep growing. And so this is an interesting one. So I probably met with, I would say, a dozen individuals over the past year, all of who are worth probably 2 to 3 million plus. And they're not driving luxury brand vehicles. They're not wearing Rolex watches. They drive Hondas, Toyotas, Volkswagens. They are, not spending thousands of dollars on designer clothes. But where I have seen that very commonly is with people who have credit card debt, with people who are trying to impress, and with people who essentially value the appearance of having money more than they actually value having money. And so one of the key things that I've noticed with these individuals, this is a really good thing to kind of take to heart here, is that they value actually having financial security and wealth in their bank accounts versus showing that to the world. And so I'm not saying you can't do a little bit of both, but you can't do it before you've attained it. And if you do it after you've attained it, it has to be in a reasonable amount that you are not depleting what you've been able to attain. Because I want to be very clear, good job having $1 million by your 30s. That's amazing. That is not going to help you accomplish all of your financial goals long term, especially if you start spending that money early. And so we want to make sure that, and so from habits that they've formed in terms of their lifestyle spending, budgeting, cash flow tracking, all of those things, to then how they react to different market circumstances. We talked earlier about how millennials and young individuals often are not as in control of their emotions. And it's hard to draw that emotional detachment from what I feel to how my money is doing. And so when we see money in the markets, when we see it drop, our heart drops along with it. And we want to, we just exit because we just want to cover losses. I was talking to an individual friend of mine who works on a portfolio management team at one of the big banks, and they work in the audit section. So they do audits on companies' cash flow statements, and so, or financial statements. And so one of the things that he even acknowledged was that when it comes to individuals, you can be the smartest person in the room, but you can make the dumbest decisions with your own money. And there always has to be someone who is going to help you make sound decisions with your money. Right. And so our emotions play into that. Now, what these individuals have done is either they've been able to master their decision-making habits, and they've studied and they have high financial IQ and high financial literacy to know that they're just not going to touch whatever they've invested, or they've hired someone to come along that journey with them, someone like us to come along that journey with them to help them not make those bad decisions around money. And again, I find this so much more frequently. So these individuals that have like $2-3 million, they are so much less disturbed by market reaction, like a 20% drop, which to them could be like $400 or $500 gone in a month or a year, than someone with $100,000 that sees a 10% drop. So it's this mindset shift that these individuals have. They've developed these habits over time, whether it's through risk taking, whether it's through financial literacy, whether it's just the high financial IQ experience, their parents, whatever that is. They've developed this ability to not make emotional knee-jerk reactions when bad things happen to their money, and it's about staying invested in the long term.
Yeah, I have one comment to make on this around seeing money as a flow that is kind of free flowing. It comes and goes, right? And I noticed it very clearly through my conversations, but also the recent clients that I've been working with. And the people who are in that mindset that moved away from, I would say, scarcity mindset, or maybe they've never had to really deal with this like personally, you can tell it's a day and night difference. So even when I look back with your conversations with people who, like, when, money doesn't grow on trees, money is very scarce. It's very hard to get. And I grew up that way, but even through conversations, like we'll share like, hey, this financial plan costs $2,000. Like, yeah, but like that can show you right now, it's probably going to give you over 10K, like in the first year alone, and let alone like over your lifetime. But even that, like those are big investments, right? And then you compare that to like business owners for example, and it's like, hey, it's going to be $3,500. Oh yeah, I already sent it yesterday. When are we starting? Like money just, and Alex Hormozy made a post about this, and I'm kind of paraphrasing here as well, and a little bit of what he shared. But I was listening to him, and I literally experienced that, and I was like, holy smokes, it's like day and night. Like once you get into that flow of state where money just comes and goes, like again, market cycles don't impact you as much. Again, how much you're making, how much you're like, again, as long as you control your spending, of course. But yeah, there's just the whole relationship with money is just a whole new level, and they understand that they need to spend for the right advice, because they're not going to get it back multiple times over the lifetime. So yeah, I've really, in the last year, this was day and night in terms of just the speed at which even those people are making decisions, right? They recognize the value. They're moving a lot faster. Once we recommend certain actions, they're implementing them right away. The time between the knowledge that they get and the time they put into action is so short. And I'm learning that, and I'm like, holy smokes. So I'm looking at doing this for my own life in terms of when I'm learning something, how fast does it take for me to put into action? And I'm trying to work on this in all areas of my life. Because if I can narrow that gap, I think I'll be a lot more successful. 100%.
Yeah, you hit the nail on the head. And I think one of the big things I've noticed with individuals who've achieved success in any area of their life, whether it's their business, personal life, those types of things, is that they recognize the value of their time, and they can differentiate between an expense and an investment, right? And that's not to say every investment they make is a good investment for that, but they've learned from the experiences of what is and what isn't a good investment. Like, they probably don't need to buy another course on how to get wealthy when they're worth over $1 million in their early 30s. Okay. But so that would be an expense to them. That's something, an expense not worth taking. Right. But in another sense, an expense, like I was thinking about this, like Sean McVay, he's the coach of the Los Angeles Rams. He has a guy that he hired on his personal training staff to essentially manage his emotional levels during a game. And so that way, this guy basically comes in and says, and if he gets too excited with himself, he runs onto the field, the guy literally drags him back, right? Or if he's getting too overheated, the guy will take him away for a second. But he manages emotions during the game so that his sole focus can be on coaching his team, executing the plays, and making sure everyone's prepared in the right situations. And so obviously, not like most of us would view something like that as a really bad decision to make with money, right? He's got a limited budget. He's got to hire the best staff, all of these things. But in his mind, him being 100% focused on the sole object of what his job is was more important to him than perhaps taking a larger percentage of that budget for himself, or even just, having another special teams coach or another type of coach on the staff. This was because he felt that he could add more value to the team if he was 100% focused. And so I think business owners, in general, that are successful have that mindset. And everyone has that mindset when they reach a certain level of like, is this my time? Should I hire someone to clean my house? This is actually an interesting example too. Like, everyone harps on like the 1% or the 0.5% fee that it costs to have their money managed on their behalf. And we liken it to like putting someone like a brick wall in between you and the sell button on your portfolio. But everyone kind of harps on that fee, and that it's so expensive that it erodes wealth over time. And of course it does. But is it a fee? Is it an expense, or is it an investment? I like to give this example when we talk about this specific thing, which is like, if you're wealthy, would you hire someone to clean your house to save you time so that you can spend more time with your family, more time on your business? And a lot of people will answer yes to that question. It's like, well, it'll be cheaper for you if you could just do it yourself, right? You'd be saving maybe $200 a day, something like that. And by the end of the month, you might be saving, $1,500 to $3,000 a month. Like, why wouldn't you just take that extra money and, reinvest it into your business or something like that? But what they'll say is, well, that frees up my time, and that allows me to focus on the more important things in life. And that's in effect what good financial planners and money managers will do. It'll take a really big part of your life and decisions off of your plate from an emotional management standpoint so that you can focus on the things that really matter to you. And that's where I think and not everyone needs a financial planner. I want to say that first and foremost. Not everyone needs a financial planner, but if you could better spend 2 or 3 hours a week managing your business and make your business extra thousands of dollars a month because you spent that extra time versus studying charts, trying to figure out what the best investment is, all of those things, that's time that you now have back in your pocket. And that's peace of mind that you now have that your money is being managed well for you so that you can focus on things in life that really matter. So I wanted to frame that a little bit differently for people because I feel like that is a topic that's probably one of the most pushed back on from people having others manage their money. Look, I'm not going to sugarcoat it. It's an expense. Do you view it as an expense or do you view it as an investment? It's the differentiating factor between the people who have their millions and have chosen to invest and use us as their financial planner and money manager versus those people who don't feel like it's a good investment and have chosen to do it on their own for whatever reason. Maybe they've been burned before. Maybe they actually have a lot more time in their day now. But for those individuals that don't, it becomes a really valuable investment.
Yeah. Yeah. It's all about the value that you're getting for also what you're paying. And sometimes it's not always quantitative, right? It's hard to quantify everything that you're getting back for what you're paying. Now, for number 4, for what is the fourth thing that millennials do?
Well, I feel like this is your wheelhouse, man.
Yeah.
You want to go through
health and fitness. I would agree with that. Sure. But I would agree with that. So I think I think I mentioned that in the podcast before, every single one of my clients, which now I'm getting close to 2 hands, by the way. So this is how much I've grown in a year.
Nice.
Most of my clients, work out or do some sort of, physical activities, I would say. But I think this is well researched, whether you're looking at all the top CEOs, even Barack Obama, like at 4 or 5 a.m. was working out before his work day. Tim Cook was working out. I was listening on a podcast and he was the guest, actually Sahil Bloom. I met Tim Cook because Tim Cook wrote the foreword on his book. Then Nick Bear was asking him, like, how did you meet this guy? I met him. He was going to, and what's that fancy gym in the US? It's blanking, but they were going to this fancy gym at 3:30 a.m. And it was there was like 3 people in the gym. Then Tim Cook was one of them. He was there. And that's how he built a relationship with him. So I think, having making health and fitness a priority. And I think also working with professionals in that field, I think can go a long way. Even personally, I'm working with a running coach right now. I've never done that in my life. And it's crazy how much you're learning and you're improving when you're working with someone. I know you're working with across, through the CrossFit coaches at CrossFit gym, but it's like in any field, right? When you're leveraging expertise in that field, it can have, what is that? Oh, sorry.
Yeah.
Apple Watch?
No, it's the
Whoop band. Okay, sorry. It's
the Whoop band. Yeah. So,
yeah.
anyways, yeah.
Hell yeah. That's awesome. Yeah. So tracking your sleep, HRV status, heart rate. Like I'm tracking everything now, and just to try to make better decision and listening to my body, having better body awareness of how I'm feeling, how I'm doing, and then how, again, to perform. Because if you perform in one area of your life, that you're going to end up performing in all other areas of your life, especially if you're a business owner. So as a business owner, I think it's just saving me. And
what do you think it is, the
correlation?
Like, what do you think it is? Because not everyone who works out is wealthy, but you do get the sense that the overwhelming amount of people that have built their own wealth, to whatever extent you want to call it, have fitness and health top of mind. And I think that even might be different in our generation than it was in our parents' generation. Although my dad would be an exception to that because he's turning 70 next year and he still swims mile laps at the field house and does the exercise bike. And he's probably his biological age is probably fit. He's super in shape and all that stuff. But what do you think it is, the thing that actually makes successful people want to also be successful maybe in other areas like their health and fitness?
Well, that's a big question. But the realization that I came to over the past year, and I reflect a lot, all I do is I run and I don't listen to music, and I just run in silence and I think. I think a lot, 6-7 hours a week right now. I'm just thinking, right? If I'm not running with someone. But I came to the realization that you're talking about successes. I think that people who are very successful, it's very simple. All they do is they take action and they're disciplined. And it's over time that their success is shown. But this is true whether it's in their business, and you talked about this earlier in this episode, you need to stay around. You can't beat someone who's never giving up and who's just sticks around. Like it's just keeps at it and keeps chipping at it. And it's been decades. And, advisors have been in the industry for 40 years. Yeah, of course you're going to be successful, man. The market is like 10x over that period. But the whole point is, whether it's your fitness, like people have, like I've been working out for 20 years. Like when you do something for such a long period of time and you never give up, you appear to the outside world that you're extremely successful. But in reality, it's just a way of being. It's just who you were all along the way. And it never actually looked very, successful, I felt, along the way, unless you stop yourself and you look at what you've accomplished now, but you don't really do that day in, day out. So it's very interesting. But that's what I came to realize is, and taking action, whether it's going to the gym is taking action, whether it's growing a business, like that's what I also, focus on servicing business owners. And what I've learned being a business owner is, compared to an employee, not all employees don't take action, but business owners, it's a next level. If you don't do anything, nothing is happening. And
it's the freedom to take action.
The amount, right?
It's the freedom to take action as well. Like you can't always do that. When you're reporting to someone who's overseeing you, you can't just say, "Oh, I've got this great idea, I'm going to go implement it." But as a business owner, like how many times have we had conversations where like, "Hey man, I read this in a book. I'm going to try this out and we'll see what happens." Right? Like it's just the speed of which you can execute something you just learned, like you pointed out.
Yeah. Okay. Number 5. What is one of the most common thing that we see millennials implementing?
Well, I think the most this one is perhaps the most important part, is that they're actively seeking the next milestone to hit. So they don't stop, because if you looked at like, hey, I'm 30 years old, if I let $1 million compound at market rates for 30 years, after 10 years, I'd have 2, after 20 years, I'd have 4, after 30 years, I'd have $8 million, right? So by 60, I could have $8 million. That's a conservative growth rates, maybe let's say 6 million. Like that's enough for you to live comfortably on at 60, right? So, but the thing that I've noticed, especially when, people are young and they've accomplished this, is that now it's on to the next type of goal, right? Whether that's continuing to grow their business, whether that's hitting that next, maybe instead of $1 million in assets, maybe it's $1 million in revenue, maybe it's 2 million, 10 million, what have you. But a lot of the time we also see a shift from just trying to get that next dollar to what impact can my money have? And what do I want to accomplish outside of just my business or my personal net worth for my family? So we see a lot of switch from, okay, now I want to set my kids up. Okay, now I want to set my parents up. I have clients who paid off their parents' mortgage, and the amount of joy and happiness that brought to them, the whole family, it's amazing, right? And how meaningful that is. We've had clients put aside $50,000 for each of their kids the day they were born because they had the capacity to do it. And now that money is compounding for their kids. And by the time they're 18, they're going to have, $100,000, $200,000 just sitting there available for them to utilize. And so those are, people start to dream about what's next, right? And sometimes that leads them into, well, I've accomplished everything I wanted to from a wealth perspective. Now, what's my impact on the world going to look like? So I'm going to switch careers, or I'm going to start giving to charity, or I'm going to spend more time with my family, whatever that looks like. There's always that next step that these individuals are trying to attain. It's not always wealth related, and it's definitely not greed related. In most cases, it's, I've got obviously a gift that I can continue to use. What's my best way to use this gift now? Because my family's set up. Now what do I want to do for the rest of my working career or what have you? So that's always been such a fun conversation when we dive into the goals and values meetings with these individuals. Sometimes it's not very well thought out. When I say that, I'm criticizing them. What I'm saying is it's not like they've taken a lot of time to think about it yet, but we can help them flesh out those ideas in those meetings. Other times it's like, I want this, 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 and this. I want to accomplish this by this age, this by this age, this by this age. Okay, here's your blueprint. And so those goals and values meetings are really, really fun to sit through. Probably my favorite meeting, because we really get to hear the heart of the individual that we're talking to. And then, so that'll be the fifth one, is that they don't stop there. And they always want to move on to the next.
Yeah, that's that's you've covered some really great points that was tied with what we opened up, especially around the book's recommendation, from success to significance. Like, again, when they get to that point, the significance becomes way more important, because again, the success part has been taken care of, which can be relative, right, from person to person. And sometimes it doesn't have to be, especially what they cover in the book, it doesn't have to be financial success per se. You can move to significance even if you wouldn't, let's say, see yourself as having like tremendous financial success in a way, right? So that it's relative and it's very unique to each person. But yeah, to summarize the 5 common things that we see millennials do to maintain and grow their wealth. So number 1 was diversify their holdings. Number 2 is they seek out advice of professionals, tax professionals, financial planners. The third thing is that they develop good habits around money. So they don't change because they've achieved that level of success in their business or by any other means. The fourth one is that they focus on their health and fitness and longevity. And then the fifth thing is that they now move from success to significance, or want to tackle other goals and objectives that they have that, again, will have an impact on other people, on the community, charities, or any other things that are important to them that they always kind of wanted to do, and now they have the means to do it, which is amazing. So those are the 5 things.
Amazing.
Cool. Awesome. Well, that's a wrap. So thank you for listening, and see you in the next episode.